Welcome to the Grow Your Law Firm podcast, brought to you by PILMA. This podcast helps lead lawyers to more growth, profit, and freedom. Here is your legal marketing expert and host, Ken Hardison.
Hey, Grow Your Law Firm listeners. This is Gracie House with PILMA. If you're serious about growing your law firm this year, you need to be at PILMA's 2026 Summit. This is 3.5 days of deep dive content on marketing, management, and AI built specifically for personal injury law firms. We're talking our biggest agenda ever with dedicated tracks for law firm owners, COOs, intake teams, marketing, and AI implementation. So whether you're scaling your firm or leveling up your team, there's something here for you. And because you're a Grow Your Law Firm listener, we've got a special offer. Use code 26SSGROW at checkout to get 10% off your registration, specifically for Grow Your Law Firm listeners. You can grab the link and code right below in the show notes. Spots are filling up fast, so don't wait. Grab your ticket and we'll see you at the summit.
Hey, it's Jenna, Membership Growth Advisor with PILMA. If you're serious about growing your law firm this year, don't miss your chance to book a free law firm growth strategy session with me. We'll break down what's holding you back, identify the biggest opportunities in your firm, and map out the next steps to accelerate your growth. No pressure, just real strategy and direction tailored to you. Click the link in the show notes to schedule your free session.
Hello, everyone. This is Ken Hardison, and welcome to another episode of Grow Your Law Firm. And today we got a special treat for you. We got a best-selling author, Bob Fraser, number 3, I think, on the New York Times list. Is that right?
USA Today, that's right. Yep.
USA Today. It's Invest Like a Billionaire. And I read this book right before Christmas a couple months ago, and it's the best book I've read on investing in my life. And I know, what has this got to do with growing your law firm? Well, here's the other thing about growing yourself and growing you individually, and the money that you make, you want to hold on to it. And what you're not putting back into your marketing budget or whatever, you need to put it in a safe place. And I know everybody loves the stock market, and I think it's fair to put some of it there. But there's things called alternative investments, which I feel like are a lot safer and diversifies your thing. And after reading this book, it just made so much sense to me that I actually taken all my money out of a 401k and put it into a self-directed IRA and going to invest it in alternative investments. So I believe in it. My first time to actually meet you, Bob, even though I read your work.
Yes, pleasure.
And they own Aspen Funds, if I'm correct. And it's not just for the super mega billionaires. It's for guys like me and you that are making, more than just $100,000 a year and got, some money. But their investments, if I remember correctly, you can put as little as $50,000 in something.
Yeah, sure.
Or 100 or whatever you want to, millions if you want to. Anyway, you can tell me your background or whatever, but I really want to know why you wrote this book.
Yeah. I
really do.
Yeah, well, it's a great story. I started at .com in the late 90s and blew it up, and was worth several hundred million on paper, and then lost everything in the .com crash of 2000, 2001. Sometime later, then became a professional stock market investor, and lost everything in the great financial crisis in 2008. Again. And at that point, I got sick of the public markets. I'm like, there is a better way to make a living. And I'm passionate about investing, and decided to look at private alternatives. And at that point started a distressed debt fund. And it turned out to be a really good time to buy distressed debt. And we made a lot of money for our investors. And it's been kind of off to the races since then. And I'm passionate about this topic, invest like a billionaire, because most of the little guys invest, most of their wealth in the stock market, and the billionaires do not do that. So your financial advisor, whatever he's telling you to do, the billionaires are not doing that. They're not doing that. None of them are even close to doing the strategies that these guys are telling you to do. Okay, the billionaires invest 20 to 30% of their wealth in the stock market, and they invest 50 to 60 into private alternatives, and they're far superior in many ways. And they have a couple disadvantages, but they're very superior. And so really my passion is to unlock this for the little guy And the little guy is, yeah, millionaires. Okay. A normal millionaire. In order to invest in these private alternatives legally, you must be an accredited investor, which means you have 200,000 in income for the last 2 years and you expect to do the same this year, or a million in net worth apart from your primary residence. And if you are that, you have legal access to these alternatives and you can get, higher yields, better income, less volatility, a lot of different things. And each one, as I describe in the book, each one of these asset classes has a different superpower. And so what you can do is basically construct a portfolio that fits what you want to do. And unfortunately, your financial advisor, unless you have a unicorn financial advisor, is not going to help you do this. They're simply not trained to do this. They don't understand alternatives. They've never invested in alternatives, and they really don't know. The system doesn't train them to do that.
So can you give us these examples? Because I mean, before I read your book, I had no idea what alternative investment was. I mean,
Right.
I really didn't.
Right, for sure. So a lot of people, maybe some of our listeners here, they get into DIY real estate, which I would not call private alternatives. So DIY, you go in with your son or your daughter or your partner or whatever, and you buy a little apartment complex or a duplex or something, rent it out. No, that's not what we're talking about. And maybe you've invested with your brother-in-law and his startup, right? Those kind of things. That's again not what we're talking about. That's not venture capital. What we're talking about is professionally managed private investments. So this is where a company forms an LLC to go buy, just pick an example, an apartment complex. And they become the general partners, so they're the managing partner, and you become a limited partner, an LP, which means you don't have any liabilities that the GP has, but you own that investment business, and you have a right to the income from that, or according to a waterfall as set by the GP. So that's the basic structure. It's pretty simple. I mean, any attorney surely knows what I'm talking about. And some of the asset classes, the first asset class that a lot of people get involved in is commercial real estate. And there's a lot of classes of commercial real estate. There's residential, like, apartment complexes. There's industrial, big box industrial, which we do quite a bit of. There's retail, and each one has its own characteristics. But in general, real estate is very, very powerful because it has great tax benefits, number one, and it's the ultimate inflation leverage, right? If you want to make money from inflation, real estate is the way to do it. And so you invest, you place capital with a fund. They go buy the apartment complex. It's professionally managed, it's professionally underwritten, professionally purchased, and you don't really have to do anything. And you get the benefits of that. So that's step one. Another one is private credit. So the private credit is private lending. So we have two private credit funds that we've operated, just as for instance. And private credit lends money, in our case, to real estate, buyers, commercial real estate. And so we run preferred equity or mezzanine debt. We end up getting very high yields. We're getting, high double-digit yields, and we're passing on to our investors 11 to 12% yields, cash flow, okay, from making these lending. And we manage it. We originate these loans. We do all the underwriting, and we send monthly checks to investors. So income is one of those things. So you're to the age where you're probably looking to figure out how to take some capital and turn it into income. Well, in the public markets, that's virtually impossible. Virtually impossible. Yeah, you can do bonds. You can get 4 or 5%. You want to get any more than that? Good luck. There's a mortgage REIT that I followed and invested in. It's called Annaly, and they invest in mortgages. And yeah, you can get double-digit yields, but the volatility is insane. I mean, it's like you can wake up in the morning and it's down 20%. So it's really difficult in the public markets to get income. In the private markets, it's not that difficult. You can kind of choose your comfort level, where you're comfortable risk-wise, and where you need to be income-wise. And so private credit is a good example of that kind of thing,
And I remember reading the book. It's not like that you're not going to give a 90% loan. I mean, you're going to have.
Oh, no.
you're going to have it where if they go under, you're going to be pretty safe. What I'm
Oh,
saying.
yeah. We manage this stuff. I mean, the pluses and minuses in private, you can make much higher returns, you can be much safer, but the downside is you have to select your operators well. There's the variance between your best operators and your worst operators is a very large delta, much larger than the public markets. So that's where you earn your hay. But yeah, we're not. I think we're up to 80% on the last dollar in on our that lending fund, and we're like 50% in another one of our lending funds. So it's very, very safe. We manage those things. We're on it. We're really looking at every deal and making sure they're doing what they're supposed to be doing. And we have a ton of rights. So we have the rights to force a sale, change the property manager, doing a lot of things, which we're very, very aggressive in doing that to protect our investors. And we only get paid if we're making our investors money. So, guess what we care about, right? We're very, very concerned about making sure our investors are making money. And so we're very good at it. But that's part of the magic of you as an investor, is to find the sponsors that are aligned, that you believe in, that do a really good job. And there's hundreds of them out there, and thousands of great operators.
Yeah. And then there's also, you got private credit, you got real estate, and then you got private equity, right?
Yeah, private equity is the granddaddy of all private investments. And this is where, you invest in a company, in a fund that goes and does roll-up strategies. I know years ago there was a, strategy to buy accounting firms. And so you buy, here's a typical strategy, is you buy kind of an anchor accounting firm and you pay up. So one that's super well managed, got the top executives, high growth, all this stuff. And they're more expensive because they've got the systems, the processes, the back office, the whole schmear marketing, and you pay up for them. And then you do a roll-up strategy where you go and find the underpriced, the kind of the underperforming CPA firms, right? And you buy them at a much cheaper price. So maybe the top CPA firm, you're paying 12 times earnings, and the cheaper ones you're paying 5 times earnings, something like that. Well, you roll them up at some point, and then you sell them off to, you go public, sell them off to, and I think CBIZ was this, right? CBIZ, big firm today, was this whole strategy. I could be wrong but I think I remember that. So that's a typical strategy, and they make a ton of money. I mean, typically, you're in the high teens type yields and type returns annualized in private equity. There's a lot of huge firms doing this. And, you can't be guaranteed every year that that's what you're going to get, but that's generally the kind of numbers that you're looking at. And it's the largest. It's like 40% of all private alts, right, is in private equity.
Right. And then what other kind of, and I know that then you get a little bit more risky, like venture capital and.
Yeah. Well, the next one that I like and I play in is natural resources. And we haven't talked about this, but one of the keys to this whole thing is to maintain a broad allocation, right? The idea is invest in things that zig when other things zag, right? And in that way, you ride out the volatility. And natural resources, for instance, they just always are zigging when everything else is zagging, right? So they're very, very different. In particular, I love the energy space. We're at Aspen, my firm, are very data driven. We look for where are the places that you should be investing money based on big, massive megatrends, right? The megatrends and going in the earth. Where do you want to place capital? And energy is a big one. There's a narrative out there that the world is post-fossil fuels, and it's actually a false narrative. I mean, I wish it were true, but we are not post-fossil fuel. We're not close to post-fossil fuels. But what's happened is because of that, the world is underinvested in energy exploration and development. And for over the last 10 years, has been massively underinvested, about 50% smaller spending. And the problem is oil and gas declines 5 to 7% per year in production in every field. So if you're not replacing that, you're betting on there's a crisis happening, and that's where we are right now. So you can buy these oil fields, producing oil fields. So there's no engineering risk, no geology risk, no drilling risk, operated by public majors, and we're buying them at a 20% IRR basis at $50 oil. So the kind of thing is, if I'm wrong about oil prices and they're going to stay where they are, I'm still going to make wonderful returns. And if I'm right, it's lights out. So those are the kind of things you can do in the private space. You are buying oil fields that are operated by public majors. I love that space. It's the most underpriced space, it's a generational buying opportunity right now. Prices of producing oil fields are down about 60% from their peak, prior to the great financial crisis, and they're just on sale. So those are the kind of things you look for mispricing, you look for great opportunities, cash flow, and you can construct what you want. So we love that. We love that space.
And I know sometimes you can. I don't know about this, and I'm not a CPA, so this is not legal advice. But it's oil and gas. If you get in oil and gas, I think you get some tax credits.
You can get a lot, and especially if you're drilling. Now, because we're not doing a ton of drilling, we're only doing kind of infill drilling in our strategy. We're operating existing producing oil fields. That's what we're doing. We're buying them,
Okay.
but you still get a 15% tax break on that. So you're only paying taxes on 85% of the income. And if
Okay.
you drill, then you can get 100% of your intangible drilling costs are actually tax deductible. So yeah, if people need to take care of income, right? You had a really good year and you're about to pay some nosebleed taxes. It's real nice to buy a little oil and gas drilling just to take the number down.
So I remember in the book you were talking about, and I think it depended on where you're at, but you said, like 5% here, 20, you just said 20 or 30% stocks, but then you put so much in this, so much in that, so much in that percentage wise.
Right.
Diversify to make it where you zigzag, I guess is what you're talking about, so that you
Yeah,
can kind
exactly. Yeah, I have what we call the billionaire portfolio allocation, which is kind of modeled on what the big boys do. It's all really based on mathematics that to have things that are doing well when other things aren't doing well. Because the truth is, no one knows where anything's going to go, right? I mean, we can make our best predictions, but we do not know. The only thing you can be sure of is if you have mathematical diversification, and it's called uncorrelation. So just buying different stocks, you think you're diversified, and it's not uncorrelated. Have you ever noticed in the stock market when something goes red, everything goes red sometimes? It's like everything unrelated, right? That's because they're correlated, even if they're different companies. And I mean, you buy the S&P 500 index like an ETF or spiders. A third of that index is 10 companies. A third. So you may think you're diversifying into 500 stocks. You're really not. You're buying 10 companies that, by the way, are all highly correlated to each other. You're buying one thing. And trust me, that's just a whole lot different than the price of oil, right? And a whole lot different than private equity, and a whole lot different than an apartment complex that are very, very, they just trade differently. They work differently. And so the idea is put a percentage of your wealth into the public markets. 10 to 20% is what the big boys do. Have some bonds, but the rest put into alternatives and use them like a Lego set to kind of construct what you're after, what your goals are, where you are in your life.
Yeah, I think it's. I was intrigued by it. I mean, it made sense to me. I mean, it's. And I guess like anything, there's no 100% guarantee anything's going to work. But look at what's been done and look at where things are going. I think it's, in my opinion, and that's just my opinion, which means nothing. To me, it seems a lot safer. And I think the older you get, I think you got to be safer. I think
Yeah,
when you're in your
absolutely.
30s and 40s, then hey, I can make it back. You said you lost money twice. I mean, and I have too. But the deal is, when we get 70, we really don't have much time to make it back. If you got to kind
That's
of be
exactly
careful.
right. That's exactly right.
Yeah.
And I hit a lot of key points in the book. For example, that the point you're making that losses are far more important than gains. So a lot of investors chase headline gains. Oh, this one's 18%, the other one's 13%. I'm going to do the 18. That's not the way we should look at this. In fact, losing money is far more impactful than the gain. So we need to focus on being safe first. The very first investment, the very first, investment rule, Warren Buffett says, rule number one is don't lose money. And the rule number two is don't forget rule number one. you know
Right.
you know
Right.
so you really want to be careful to not lose money. Losses are far more impactful mathematically than the returns you make. And the truth is, if you'll compound, even 10% returns, 7% returns, 12% returns, you compound these things, you're doing super well over time. You put a spreadsheet together, you can see. And investors are just not, I find so many professionals, and probably most of our listeners here, they spend a lot of time, learning their craft. How much time have you spent becoming a fantastic attorney, right? And really learning your trade and your craft, and you spend all that time and energy, which is wonderful, right? And you're in a great income and all this, but you don't spend any time learning to be a great investor. And the truth is, you will earn more from your investments than you will earn from your career. And I point this out in the book by using a doctor as an example, that a doctor who just saves 20% of their income over the course of their 40-year career, if they can earn, 10% returns on that they make something like 4 times more money from their investments than they do from their career. And so, we just pay, I encourage everyone to take the time to buy a book like this, to read it and understand it, and be good at investing, be shrewd, be sharp, treat it like a business. Billionaires treat their investments like a business. That means go to conferences, read books, hire professionals, right? Get some help, learn it. Don't just outsource everything, right? I mean, everybody says, oh, I don't know anything about investing, so you outsource it. Those guys don't know anything either. Okay. They don't know this stuff. They don't know this stuff. They know something, but they do not know. They do not know what I'm talking about and about private alternatives. They're not trained. It's not part of the curriculum. It's not required as part of the Series 65 or the Series 7 to understand private alternatives. And very, very few, most of these big firms, they have in-house products, they have in-house portfolios, and they basically put you into a template and a system that does not include private investments.
I know that you're on our podcast, but you have your own podcast, don't you? Don't you have a podcast?
It's also called Invest Like a Billionaire, same as the book. Yeah.
Yeah, that's good branding. Good branding.
Yeah. Well, there you go. And we also have a portal called investlikeabillionaire.org. And the idea there is just join with other private investors to learn about the space, self-educate, find sponsors, et cetera.
Yeah. And so the book, Invest Like a Billionaire, I mean, it's, I guess you get it at Amazon, anywhere, any bookstore. I highly recommend it. And, read it, make your own decision. I'm not trying to talk anybody into anything. I mean, it convinced me, but you might have a different idea. And if you're 30 years old, you might have a whole different idea. I'm not going to say, but I appreciate you taking time. And I know you're busy. If you're number 3, I mean, if you got a bestseller, and I understand why, because it's well written too. It's laid out. It's not a bunch of fluff. It really lay it out. I like books like that are practical, that has practical information, not just a bunch of theory. I like stuff like that. I'm a meat and potato man. I'm not a fluffy guy. I like the meat. I don't need all the other stuff. So if somebody wants to is interested, if they don't want to read the book, they just want to talk to you guys at Aspen, what's the best way to reach them?
Aspen, like the tree, funds, funds.us.
Okay. Well, listen, it's been a pleasure, and I'm glad I got to meet you. I can't wait for your next book. It's gonna be hard. It's gonna be hard to top this one, though. I'll be honest with you.
Yeah, I put everything into this one, so I don't know if there's another
really
book.
Did. I mean, yeah, you got the kitchen sink in it. I mean, you really do. I mean, you really lay it out, and the pros and cons and everything, and what's the degree of risk. I mean, some things you get. It's like everything else. The more risk, the more return. The less risk, the less return. And that's life, right? That's life. That's life.
Exactly right. But you choose. The whole point is that you construct something that you're comfortable with, and I like that we're talking to a bunch of attorneys. You guys are super smart. I mean, it's if you'll take the time to actually do some due diligence and just learn and just improve your skill set, investing skill set, you can really leverage your career into an amazing lifestyle and, give more and support more, et cetera, et cetera. And I just really encourage everybody to learn and to learn more, educate themselves.
All right. Well, thank you so much, Bob. We appreciate it.
Pleasure, Ken, and all the best.
This has been a treat. Until next time, this is Ken Hardison, dedicated to your success.
You have been listening to the Grow Your Law Firm podcast, the podcast that leads lawyers to more growth, profit, and freedom. Go to growyourlawfirm.com to find more ways to market and manage your law firm. Please leave us a rating and review wherever you listen to your podcasts.